Hello, good morning, and welcome to Macro Ace with your host, Tony. We're going to be going through two bits of data. So we've got the US inflation readings for CPI, or the Consumer Price Index, and then we also have the Canadian employment change data as well to kind of go through. So I'm going to skim through both bits and try and give you as much detail as I can and go through some of the expectations. But let's make a little start then. So US CPI, that's going to be the main release. That's the header for today. What to be aware of, or where we're expecting a lot of market volatility from the inflation data that we get from the US. But first of all, what is the CPI release? So it measures how much consumers are paying for retail goods and services in a percentage form, and the way it's formatted and the data is collected. So you have these agents from the government that will go out to that will send out surveys to 26,000 retail outlets, 4,000 housing units in 87 urban areas, and prices are collected on 80,000 different items. So a lot of that price collection is done from those agents going around and looking at price differences, and then they kind of sum up how much the change in price is, or if there's a price difference at all, whether or not it's stayed the same. But that's the key thing. It's just a very precise, in detail report about the inflation within the US, within the US economy. Also, some key measurements then. So I'd emailed and had spoken to one of the people from the BLS, or the Bureau of Labor Statistics, and they had kind of just the figures that I had for the key measurements were more or less at the same figure that I had beforehand. But there was only a slight update. So you have housing, which is about 42% or weighted of the CPI report. So that's the biggest part of the report. Then you have food and beverages, which represents about 14%, transportation, about 18%, and medical care, which makes up about 8.5% of the CPI report in total. So of course, there are other aspects to the CPI report that make up the rest of that 100%, but these are the key measurements, as I said, that move the report that cause a lot of movement within the report either way. So the core CPI then, excluding food and energy, of course, those are the most volatile parts of the CPI report, and you can have lots of price changes, and of course, there's the geopolitical factors also play in as well. That also play a role in inflation reports, and that can exacerbate energy prices and food prices as well, as we've seen recently within the US, but also other nations and their own inflation data readings that they get. But so the seasonally adjusted figure is the month-to-month data for the CPI, core CPI and CPI month-to-month is a preferred data, right? So seasonally adjusted basically gets rid of any of the effects of let's say weather patterns changing, or maybe there's also different production cycles, i.e. maybe there's a lot less production going on, or there's a lot more production going on with that particular time frame within the year. So those seasonal factors are adjusted for. Hence, the month-to-month data and the core month-to-month data, particularly the month-to-month data gets the most attention when it comes to looking at the inflation report itself. Of course, there are other readings as well to be aware of in different times of the business cycle, and where the Federal Reserve is in their tightening cycle or easing cycle, and maybe some of the other releases will start to see a bit more of an appreciation or more eyes on those certain areas, like the year-on-year data and the core data, which generally in the normal market, when the markets are normal and the economy is on a normal trend path of growth and expansion, don't really get too much attention. But hey, Scotch and Stocks, buenos dias. Hello to you too. So the core CPI excluding food and energy. So hopefully that should kind of give you a basic idea of what the CPI release is all about. Now, How does it affect the markets? What are we expecting and what do we need to keep an eye on for? So the dollar tends to strengthen when the economy is growing and inflationary pressures start to pick up. That plays into the hand of the Federal Reserve. If inflation pressures do start to rise quite strongly, and there is a need for the central bank to tighten monetary policy or to dampen inflation or to slow it down altogether, then what they will do is that they will hike interest rates in order to do that. So in the US, you have the federal funds target, which which is basically allowing banks to set their rates for borrowing between other banks and lending out money as well. But we usually, when inflation picks up and is quite strong, that, as said, there's a likelihood or a strong chance of the Federal Reserve or the central bank to raise interest rates to control and dampen inflationary pressures. So in that regard, when interest rates are raised, the dollar sees an appreciation because it's seen as more valuable with a higher interest rate. So when investors and people in business, when they're trading, let's say in dollars, of course, when the dollar is stronger, then they're able to export, they're able to buy more goods and buy services abroad or within their own nation. And you've also got to consider as well that with those investors looking for a high rate of return, maybe investing in the dollar when interest rates are raised, then investing in the dollar would be seen as a good opportunity to do that. Hence, you see the appreciation in the dollar usually when interest rates are raised. So for stocks then, and the underlying inflation data, and particularly now in this current tightening phase, it's going to be very, very key to keep an eye out for. So underlying core CPI data, if it rises sharply within a month, that could lead to stocks taking a hit. So what's the underlying inflation? What's the, it's stripping out the two parts of the report, food and energy, that are very volatile and can more or less inflate the inflation report itself. Looking at the core CPI data of where inflation is really at, or how much inflation there really is key to stock traders. So usually within a tightening cycle, when I was doing my research for trading economic releases, what I noticed is that when inflation was above the 2% goal of the Federal Reserve, then any higher readings of inflation would usually mean that, of course, as I said, the dollar would appreciate, and there's a likelihood of interest rates being raised. So for stocks, that can be quite a bad thing, because when interest rates are raised, the only thing so when interest rates are raised, the borrowing cost also increase as well, and any debts that businesses have to pay back, mortgages that people have to pay as well, start to increase and rise, right? And also borrowing for normal consumers as well. That also rises as commercial banks raise their interest rates to kind of fall in line with the federal funds target range of what they've set it as. So that's why stocks usually, when we're in that tightening cycle, when the Fed Reserve is looking to dampen inflationary pressures and try and bring those more in control, then that usually, when you see higher rates of inflation figures or higher inflation readings than expected, then you see you could potentially see a strong downward reaction within the markets. So for stocks, usually high readings are not good. So for the bond market, then one thing to consider as well, that high inflation reading can lead to high yields in an expansionary environment, and also within the tightening cycle. It's more or less the tightening cycle too of the Federal Reserve. When interest rates are raised to dampen inflationary pressures, that the Federal Reserve has control of the short-term interest rates, right? So when short-term interest rates are raised, those longer-term bonds also start to see an increase as well in their yield. So for yields, it's a good sign for yields, bond yields, if you see hot inflation and the Federal Reserve and it plays into the hand of the Federal Reserve to tighten monetary policy. But on the flip side, for bond prices, with a strong reading of inflation, what happens, of course, you've got to remember with bonds is that as the yield goes higher, the price of the bond goes lower. Okay, so it's to try and attract those investors and traders to jump into bonds. That's one example. That's one thought to be aware of when we're in an expansionary environment. But the other point, the other key point is that, as I said, when short-term interest rates are raised, the long-term bonds naturally see an appreciation in the yields. So also their bond prices would potentially see a depreciation as well. Okay, so high inflation readings can lead to high yields in an expansionary environment and within a tightening cycle. So moving on then. So the previous report. So shelter, food, airfares, and new automobiles were among the major contributions to the monthly increase. The energy index for the month-to-month data declined in April after rising in the recent months. So the index for the gasoline for gasoline fell 6.1% over the month, offsetting increases in the index for natural gas and electricity. It's only 1 month of data, right? Don't just take that as inflation has peaked. Whoa, maybe the Fed is not going to tighten by that much. Things are going to start to slow down. We've only got 1 month bit of data showing a bit of a decline. However, on the flip side, then, if we're looking at the year-on-year index and how that's played out, so all the major energy components increased over the year, right? Or year-on-year compared to the previous year. The gasoline index increased 43.5% or 43.6%, and the fuel oil index rose 80.5%. The index for electricity, 11%, and natural gas increased by 22.7% over the last 12 months or over the last year. So month to month, we've got one reading of gasoline seeing a decline, but as I said, we need to look at more data to be able to say that inflation has peaked. Okay, but overall in the year-on-year effect, what traders, of course, inflation's hotly watched release at the moment. We need to be aware that we're still way above where we were compared to last year, and that's going to be a given, right? That's not a surprise, considering how volatile the energy market has been this year so far. But still, just to kind of put it into perspective of how energy has really got out of hand here with energy prices in different areas as well. Okay, so that's the previous report of what we've seen there. I think the same things we're going to be looking for is we'd hope to look for a further decline in gasoline, but also the fuel oil index too. Of course, gasoline prices have been soaring for the last couple of months or so, 3 months since the Russia-Ukraine conflict. I think the last time I checked, it was around $5. It was around $5. I think, correct me if I'm wrong, but just off the top of my head, I saw what I remember for gasoline prices. Geez, you guys are not enjoying it. Neither am I. Okay, petrol prices or gasoline prices within the UK are horrendous. It's like £1.70 for a litre, which is nuts. But anyway, moving on. So we've got about 30 minutes. So the economy at the moment, so non-farm payrolls figure below the prior at 390k. Unemployment rate was unchanged when traders and economists were expecting it to decline by 0.1% to 3.5%. Average earnings year on year at 5.2% versus 5.5%. Employment costs, so that's the quarter-on-quarter data, at 1.4%, with the PC price index year on year 6.3% versus 6.6%. That's the Federal Reserve's preferred measure of inflation. Core PC price index, which is what they really love, declined to 4.9% versus 5.2%. ISM manufacturing prices paid also declined as well to 82.2 versus 84.6. Non-farm productivity February quarter-on-quarter was at 1.4% versus minus -0.2%. Import prices also declined the last month that we had data at to 0% from 2.6. Export prices also saw a decline to 0.6% from a prior of 4.5. And PPI prices, or producer price index, also declined to 11% versus 11.2%. So these are all the key readings when you're measuring inflation overall within the USA, or within, let's say, within any other economy. You want to look at all these indexes, basically, right? This is perfect. This is giving you an overall picture. Remember, this is only 1 month's bit of data, right? All together. So we're not really getting we don't really have a true sense of whether inflation has actually peaked or not. But overall, the indexes for 1 month just showing a decline. Okay. But, you've seen stock traders get a little bit jumpy, a little bit giddy about it. But like I said, let's wait and see. Let's look at, the next couple of months bit of data and kind of see what's going on, whether or not inflation has actually declined or seen a peak. So triggers then. So the month-to-month is looking for a high estimate of 0.9% with a low estimate of 0.6%. So the forecast for month-to-month data is 0.7%. That's a median estimate. So looking for 0.2% deviation for the high end and a 0.1 deviation for the low end, according to economists. And then the year-on-year high estimate of 8.5% with a prior of 8%. So looking for 0.2 deviation for the high end, and then a 0.3 deviation on the low end, or around that there. So the core month-to-month highest estimated forecast of 0.7% with a low of 0.4%. And the core year-on-year with a forecast, or high estimate of forecast of 6.1% with a low of 5%. So remember, the core CPI, the median estimate is 5.9%. So it is expected to tick down from 6.2%, and then the core month-to-month forecast, or median forecast, is 0.5%. So that's also expected to tick down. The only the only parts of that release which is expected to remain the same or unchanged is the CPI year-on-year at 8.3%. Then the CPI month-to-month is the only part of that report, or the headline reading, that it's expected to tick up by 0.4%. Okay, so those are the triggers of what to look for according to analysts and what they've cited as their estimates as well. And I think that our estimates are also going to be similar to what they say, or more or less the same. Sentiment then. So has inflation peaked, as I said? So the last month's data show the first decline from 8.5% to 8.3%. And the core was also the same. We'd also seen a decline from 6.5% to 6.2%. However, there is still a tight labor market. And an inline or higher than expected CPI result could cause markets to reassess the forecast for September and the rest of the year. So you had comments from Fed's Bostic. Okay, this is where it got where the stocks had seen a bit of a rally and ended their 7 weeks of losses on the S&P 500. Is because one of the reasons was that Fed's Bostic had, although he's not a voting member, had hinted at a September halt following 2 basis point hikes in June and July. So the interesting thing about that is that if the Federal Reserve if we do give the next couple of months data, including today's and next month's, where you see a slow or you see a decline in inflationary pressures in Fed's Bostic eyes, or what markets were taking it as, is that could be enough for the Federal Reserve to pause with their extreme or very aggressive tightening of monetary policy. So I think if we do get lower than expected inflation figures, or maybe they are all in line with expectation, that we could see an appreciation on the S&P 500. And on the Dixie, we could, or the dollar, or the dollar yen, let's say, or the dollar overall, we could see a potential weakening from the dollar overall. For bond prices, we could see an appreciation if we do get data that is lower than expected, or more or less, or is in line with forecast. Also, bearing in mind the previous figures too, we don't want to forget about those. That's also something to consider. Is inflation actually lower than the previous figure? So we've got a lot of data to kind of keep in mind and be aware of when we do get the CPI report. China COVID restrictions easing as well. That's one thing that was announced Sunday, which had led to US stocks gaining. So an appreciation of, well, first of all, the potential for demand for the energy for commodities in crude and natural gas to see a pick up again. So that would add to inflationary pressures globally, right? If there's more demand for crude oil and natural gas. But second of all, of course, China being the second largest economy as well, that has also an impact on sentiment of whether or not the global economy can withstand COVID, and how does the second largest economy cope with it. Do we see a longer lockdown period within China, or do we see many pockets here and there of lockdowns, and there might be small dips in the stock indexes, and also in bond yields to try and stay or to try and run to the safe haven assets. But China's COVID easing, so that was at the beginning of the week. Now that's kind of gone away, that part of sentiment. Of course, now it's just inflation, right? Forget everything else. It's inflation time, baby. That's what we've got to be aware of. That and last time we had the release, I'll go through the market reactions too. Actually, I'll do that later on. I'll do that next. The yen. We've also got to be considerate of the yen and how the dollar yen has seen stronger moves compared to other currency pairs when it comes to US releases. So the 2-year yield passed 3%, which led to a new 20-year low on the yen. So this is at the beginning of the week that I made some comments about this too, and we had seen those comments coming out. So the yen being quite weak could play into the hand of the dollar yen seeing stronger, more volatile reaction from the markets compared to other currencies and other currency pairs. Just as we had seen from the central bank rate decision yesterday from the ECB, we had the strongest movement we had seen in currency pair wise was the euro to the Japanese yen, where we had seen about 77.5 pips towards the downside on the initial candle. Whereas all the other was beforehand, the biggest mover was the euro New Zealand dollar. But because the yen has been so weak so far, and it touched a 20-year low to the US dollar, that's seen a bit more volatility within the currency pairs that are traded, within the currencies that are traded with it. So that's just something to be aware of, and we'll keep an eye on that for the market reactions today. Alrighty, so the Fed view inflation may persist and widen further if labor shortages persist and wages rise faster than productivity. And if we keep going, views then, so Societe Generale's Kit Jukas, so the market's focus is on inflation data, basically, and central bank action. And then we may have a bumpy road in summer in risk sentiment, and a strong one for the dollar. 6th of June, so we know that the past month gasoline prices have been hitting a new all-time high almost every day, which could stand in the way of the overall CPI, or whether or not overall CPI data has peaked. Okay, so that's why I said looking at the core data is going to be quite key to see whether or not we do see a peak in inflation. JP Morgan just talking about, looking at moderation of CPI over the year. They note that adverse growth implications could ultimately limit the room for medium-term inflation expectations to rise significantly from current levels as well. Right? Again, they're talking about how the food and energy price indexes of the CPI report could overinflate the data, make it harder to know whether or not inflation has peaked. Wells Fargo saying, so according to one of their economists, so they're expecting a lower direction of inflation from here, or as a slow drop or a slow decline, and that pricing is a slow process. Of course, companies won't just on the dime change their prices just like that on the spur of the moment. It takes time for that to happen. Of course, it goes through the PPI data too that we also get. But the CPI report, again, they're expecting a slow decline in CPI. All right. So the biggest movers then. So from May 11th, we'd seen with an overall positive inflation reading, and you can see there was a 0.1 deviation, right? But all the other bits of data were above expectations. We'd seen 163 ticks towards the downside on the S&P 500. The brackets represents the move after 10 minutes. So we'd seen 256 ticks down. In the Nasdaq, we had seen 623 ticks down, and a total of 957 ticks down. Dollar yen about 40 pips towards the upside and 73 pips after 10 minutes. And then, so the biggest mover then of the pairs, so surprisingly, we'd seen that the Aussie dollar, Australian dollar to the US dollar had seen the biggest initial move, candle-wise. Excuse me, no, that's GBP USD. I stand corrected. So 59 pips towards the downside on GBP on cable, and then after about 10 minutes, it was about 59.5 pips down. And then so GBP USD was the biggest mover before. And if we're looking at gold, gold had seen about 52 ticks towards the downside. If we're looking at the US bonds then, so bond prices, of course, with a higher expected inflation, had seen 2-year had seen about 51 ticks down, and the 30-year about 24 ticks down. Okay, so the biggest move currency-wise we'd seen was a cable, the Aussie dollar to the US dollar. And then we had seen, we're looking, and then the dollar Swiss franc, and then where we're looking, and then of course the dollar yen itself, and the New Zealand, then the euro dollar, and then the New Zealand dollar itself there. But I think with the yen being at such a weak place as it is at the moment, I think that's one thing we've got to be aware of, that potentially that could be the strongest reactor. We could see the strongest reaction in the dollar yen for this release. But that again, that's something just what we had seen yesterday from the ECB rate statement. Okay, so let's play the video. I've got 15 minutes, and then we'll go through the other report. 10 seconds there. Okay, so we'll see how the markets move. Dollar yen there. Okay, so there we go. Data was much better than expected, and you'd seen the sharp sell-off on the S&P 500. Gold as well, seen a good movement towards the downside, and the dollar yen had seen a great amount of appreciation. One thing to note, of course, you'd seen the markets react before the release, because it's such a highly anticipated release, right? That markets, that traders were thinking, okay, maybe inflation has peaked, and seeing that movement happen before the markets had reacted. Lucky enough for those traders who did jump onto that bandwagon, that inflation was better than expected. So that movement towards the downside, could have been a nice trade for somebody. But again, you're more or less trying to wait for the figure to come out at some point. Wait for the figure to come out to see if actually inflation does warrant the kind of move that we kind of see in the markets just before the release happens. But that's one thing to be aware of. So it was a negative reaction for the stocks, for gold and bond prices, and the dollar had seen an appreciation overall in the markets, with cable seeing the biggest movement initially. All right, so that's the US release there. I know we've got the Canadian release, so let's go through that there. Oops, of course, that's the previous video. All right, so let's go through this here. We've We'll go about less than 15 minutes. So employment change measures the change in new jobs being added, includes both full-time and part-time, similarly to the US release for non-farm payrolls. Unemployment measuring just the number of unemployed as a percentage of the labor force within Canada. How does it affect the market? So for currency, that would be you would see a positive reaction where if you do see a stronger than expected reading on the employment change data, then you'd expect a positive reaction from the currency. Bond prices, you would expect to see a movement towards the downside as yields could see a movement towards the upside. For stocks, it's going to be a bit more tricky at the moment with the central bank in its tightening phase. So you could see stocks move towards the downside if we get if you get some strong data from Canada playing into the hands of the central bank to tighten monetary policy in order to rein in those inflationary pressures and to make sure that the job market doesn't get too out of control. Wage prices don't spiral out of control. If there are more jobs being added, but there's not enough slack, there's a very tight economy. Excuse me. There's a very tight labor market that is going to be caused by the increasing amount of jobs being created and less workers being available to fill up those roles. So I think the one thing to be aware of is that with the non-farm payrolls release that we had last week too, it's just to be aware that when we did have positive data, although we did see some movement towards the upside on the S&P 500, but the key gauge was that the inflationary pressure of average earnings year on year had helped to did tick towards the downside, as I showed you where the economy was at the moment. So for Canada, for stocks, that's going to be a bit more. That's going to be harder to read whether or not we do get a positive reaction from the markets. But I think we don't have any inflationary readings with the employment data, so we could see a potential movement towards the downside. The previous report then, employment increased in both goods and services in producing sectors, spread across accommodation and food services, and growth continues to outpace population growth as labour market tightens. So what I had already said earlier on. Where is the economy at the moment? So inflation being at the highest rate since 1991 at 6.8% versus 6.7%. So inflationary pressures are still quite strong within Canada. Remember, their inflation target is 2%, right? So more or less more than 3 times that amount. GDP quarter on quarter annualized was at 3.1% versus 6.7%. So we had seen some weakening from the Canadian dollar off the back of that data. So that's the annualized rate of how much the economy is expected to grow by for the rest of the year. Employment change was lower than the previous at 15.3k versus 72.5k, and the unemployment rate was at 5.2% versus 5.3%. So you did see a tick towards the downside there on the unemployment rate. GDP was slightly lower than expected at 0.7% for month on month versus 1.1%, and the S&P manufacturing PMI came in slightly higher than expected at 56.8 versus 56.2. So the employment change then, the high and low estimates that we've got to be aware of. Highest estimate according to economists, they're looking for 80k with a low of minus 1k. So if we're looking at today's Canadian employment change data, forecast or median forecast is 27.5k. So that's about 50k or about 50k deviation that they're looking for the high estimate, and then the low estimate of minus 1k. So about more or less looking for about 28k deviation on the low side for the employment change. Unemployment rate is expected to the high estimate is of 5.3%. Median estimate is for it to remain unchanged at 5.2. The low estimate is 5.1%. So remember, with a higher unemployment rate, that's worse for the economy, of course. And then with a low unemployment rate, that's going to be better. So you'd expect some positive reactions from the Canadian dollar and possibly the Canadian stock indexes, Canadian stock index too, as well. So that's the triggers there. Sentiment. So the Canadian dollar was up against the greenback on Monday after China relaxed some of their restrictions, particularly in Shanghai and some of it in Beijing. So remember, when crude oil prices see a movement towards the upside, about 17.5% of Canada's total exports is made up of mineral fuels, including oil. So when fuel prices, when crude oil prices see an increase, you see an appreciation in the Canadian dollar too. Saudis also raised their official selling price for Asia as well by about $2.10, being confident that they are seeing stronger demand. So again, the Canadian dollar had seen an appreciation from that. And it was also the best performing G10 currency year to date. It was up by 0.73% against the dollar at around 1.25%. So that was from Monday, is what I picked up for. But it was considered the top or the best performing G10 currency because of all the volatility that we've seen within the oil markets. That's helped see the Canadian dollar see that appreciation there. So Bank of Canada, so June 1st, they raised their rates by 50 basis points to 1.5% on June 1st. Bank of Canada on June 9th as well, they had... hold on, sorry. Something's going on. What have we got? Whoa, that video's playing. Don't know when that had to happen. Let's go back to here. We've got about 7 minutes. So Bank of Canada said the global monetary policy tightening will put financial systems resilience to the test and may could also exacerbate current financial vulnerabilities. And on June 1st, they had said that wage growth is picking up and is broadening across sectors. So that wasn't the rate decision when we had that on June 1st. So Citi sees a forecast figure of 35k with a low estimate of 5.3k, with an unemployment rate at 5.3%. Bank of America sees 18,000 jobs being added with unemployment rate to stay unchanged. And BMO sees 10k jobs being added with the unemployment rate remaining unchanged as well. So let's go to the previous release then. And I know I'm doing good for time here. All right, we've got 6 minutes. Okay, so about 6 seconds before the release. And of course, keep an eye here on the dollar CAD and how it reacted. Okay. So the Canadian data, Canadian unemployment rate did tick down. It was in line with expectations. Canadian employment change had seen less jobs being added. Okay, so forecast was 40k, actual was 15.3k. And there we go. So we'd seen. Of course, we've got to bear in mind non-farm payrolls release had also caused some extra volatility. So, the data itself, Canadian data, the key thing was that the unemployment rate had actually ticked down. Hence, we'd seen some of that Canadian dollar strengthening against the dollar. Of course, we don't have non-farm payrolls today, so we should expect a cleaner reaction from dollar CAD. Well, actually, forget that. If we're looking at other currency pairs for the Canadian dollar, we should get a cleaner reaction. I think today we're going to get a mixed reaction with the US dollar CAD, like we did last time with non-farm payrolls. Of course, CPI is going to outweigh everything else, importance wise. So if we keep going, move forward. So that was the dollar CAD. It was a bit mixed. But if we look at the deviations of what we had seen last time. So let's get the deviations up on here. Right. So Canadian employment change. Okay. So May the 6th on dollar CAD, we've seen about pips towards the downside, and after about 10 minutes, we're 5 pips down, 5.5 pips down. CAD JPY, although against the dollar, we'd seen the non-farm payrolls release kind of outstripped its importance. Against other currencies, though, what we had seen was a bit more of a mixed reaction here. So CAD JPY had seen about 11.5 pips up, and then had seen 9.5 pips. Oh, so excuse me. What I mean is it would seen 9.5 pips down, and then 11.5 pips up, and in total, it was up by about 6.5 pips. GBP CAD had seen 27.5 pips towards the upside, and then after about 10 minutes, about 16 pips. And Euro CAD had seen about 17 pips towards the upside. So GBP CAD was a stronger mover there, although it was also a nice clean move compared to what we've seen on the CAD JPY and also the dollar CAD there as well. So I think GBP CAD will be one thing to be aware of too when we are looking at the markets. Okay, a couple of minutes left, not too long left. Let's go to our trading area here. Let's get Tick Strike open too, and see if I can close that. I'm going to put my financial juice here for now. Alrighty, we'll keep an eye on the US. Minutes. Go on GP CAD. Rid of that. Don't need crude. Let's get gold in there as well. GP USD. Get my 30-year bond. I know I have seen comments in the chat, but there's quite a bit to cover. So, okay. There's my dollar CAD. Let's get my NQ as well on my dollar yen. Okay, let's put that there. Okay, that should be enough. Euro dollar 2. Okay. All right. Are we pumped? Are we ready for this? This is we might even see, like we saw last time, the market's trying to trade the release before the figures had even come out. So just being aware of that. Whew. All right. Looking for but yeah, so if we do get negative figures, see an appreciation on the S&P 500. If we do get positive CPI figures, better than expected or higher than expected, then we'll see a depreciation on the S&P 500. Okay. 1%. That's higher than forecast that's higher than the forecast of 7%. S&P going down, so 1% higher than the forecast of 0.7%. CPI year on year 8.6%, 8.6% higher than the forecast of 8.3%. Core CPI year on year 6% higher than the forecast of 5.9%. Canadian employment change at 39.8k, higher than the forecast of 27.5k. Canadian unemployment rate 5.1%, 5.1%, a tick down there from 5.2% as the forecast. Core CPI month to month. So all the CPI data in the US seeing an appreciation in their values. The dollar seeing that move towards the upside. So I know we're looking So I know, of course, we're looking at the dollar CAD, but let's bring up GBP CAD as that was the bigger mover last time, or the biggest mover last time. Probably, let's see, what do we get? What we got, son? Okay, so GBP CAD seeing a decline there. Like I said, the inflation data was going to outstrip what was going to take precedence for the dollar CAD. If we're looking at the employment data. But yeah, there we go. Heck yeah. Woo. So inflation, ain't peaked yet, son. That was way better than expected. Remember, the markets were looking for it to remain unchanged at 8.3%. And traders and economists were looking for a 0.2 deviation on the CPI data, and it came in much higher than expected. So inflationary pressures still there. Core CPI data, though, As I said, that's a key thing to bear in mind. So it did, if we're looking at the prior figure, did tick down by 0.2% compared to, if we're looking at the actual figure compared to the prior figure, but still higher than the expected forecast of 5.9%. Let's get some market reactions. Also, I want to have a look at gold too. Yes, gold indeed. Let's see what you're doing, son. Like I said, be careful. Inflation ain't peaked, has not peaked yet. There we go. So somebody said in the chat, Poco MHD, bound to see gold pick up. Well, I thought he said bound to see gold tick down. There we go. So that didn't happen. Gold. Let's measure the ticks then. If I can get. I can. Okay, so the energy price index was the key mover here. So it declined in April, but it increased in May. So about 61 ticks was the downside on gold. S&P, that beautiful move, huh? Oh, lovely. All right. Whoops, don't want to do that. Okay. Thank God we didn't get any like mix data there. Otherwise that would have been harder to kind of trade the release. The S&P 500 seen tick down. So there we go, 189 ticks towards the downside. The initial candle, dollar yen. So overall, data much better than expected, and we'd seen that negative reaction from the S&P 500. Gold, of course, has seen a negative reaction, of course, as the dollar. If we're talking about market correlation, as the dollar picks up in value, gold depreciates in value. Just one thing I probably could have mentioned, but kind of mentioned it now. I guess kind of just for your own bits of knowledge. So that's about 55 pips towards the upside. So don't worry about that 550. It's just kind of just change the way it looks. There we go. 55 pips towards the upside there on the dollar yen. Dollar CAD. Let's have a look at that there. So what I'd like to do is go from the bottom of the candle to the wick. Right, so that's about, whoops. No, can't do. Okay, so that's about 38 pip move towards the upside there. Okay, so about 38 pips there. GP CAD, so looking at the employment data then for Canada, which is better than expected. Dun, 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 dun. Whoops. Okay, so that's sort of seen about 31 and a half pips down. Let's have a look at EuroCAD too. And also, what I also want to do, and what I should have done for the last ones, is look at the Canadian dollar with the New Zealand dollar and the Aussie dollar too. So let's make sure we do that now then. Oh wow, okay. Okay, so getting some markets pricing in. Futures price, US interest rate futures pricing in about 215 basis points in cumulative Fed hikes in 2022, and Fed funds rate of 2.985% at the end of December following that report. That's according to FedWatch. So we go EuroCAD, about 20 pips down. Let's do Euro NZD. Let's have a look at you. Let's see what you're doing. Excuse me. Whoa. Oops. No. Sorry. Silly me. NZD CAD. Okay. Alright, so 30 pips down. And then AUD CAD. Did anyone else get a sixth sense that inflation was going to be higher than expected? And kind of like like I said, 1 month's bit of data is not enough. And lo and behold, there you go. So that was about 34 pips towards the downside on the Aussie dollar CAD. Let's also look at the bond prices too. So let's look at, so we go here, let's go 2 year. Let's see what happened. Presume went, bond prices went down. Yep. And the bond yields would have gone up on that, on the 2 year. 51 ticks towards the downside. Let's look at the 30 year ZB. Dang, okay. So, yeah, traders are looking for 3.5 base point hikes over June, July, and September now, from what we can see. All right, we're in for a bumpy ride here. And then about 18 ticks towards the downside. So bond prices reacted in the way that I expect them to, with high inflation readings. The S&P, the dollar itself overall. Of course, let's have a look at Euro USD. That's one thing we don't want to miss out. It's also that's the most liquid, the most traded currency pair. It's about 35.5 pips towards the downside. All right. So one thing I've got to just kind of just double check then was what was actually, no, we've got other bits of data. So USD Swiss franc. I've said this before, but I always say it's always quite nice when the markets kind of react in the way that you expect them to. And you get kind of like nice trades like this. 36 pips up. So 36 pips up there. So dollar yen, about 55 pips. It looks to be that the dollar yen was the biggest mover then compared to the other currencies. Actually, one final thing I didn't check, GBP USD. Because that did have the strongest movement initially compared to the other currency pairs. Nope. All right. So dollar yen had seen the strongest move. Okay. So, so what this has confirmed to me, and I think for traders too, hopefully it has. But the key thing is that, as I said, the yen hit a 20-year low and was considered and is really weak at the moment. Of course, with other central banks tightening their monetary policy, right, and the Bank of Japan continuing to ease within the US economy. Hence, we had seen the dollar yen see a bigger reaction within the markets. Actually, let's look at the Canadian data too. So if we do CAD JPY, so if the data was better than expected, let's see how strong of a reaction compared to some of the other currency pairs was. Oh, that's ugly. Oh God. Okay. Right. Here. About 27 or 28 pips there. So I want to make sure I've got the right time too. Yeah. So, wasn't the strongest mover overall compared to some of the other currency pairs, but it looks to be in fourth place instead. If we're looking at the overall market reactions, so the strongest mover. Bring it up again. We've seen about 34 pips towards the downside on the Aussie dollar to the Canadian dollar, and that's something I should have added in for you guys. Of course, apologies, but of course, this is a service that we're improving and constantly changing to make it better for you guys and giving you more data. I know there's a lot of comments in the chat that I need to kind of get through, but there's just so much data that we've got to get through and a lot of measurements. So Hope you guys do understand that, and I appreciate your patience as well. If that was useful, did anyone trade the data? I haven't looked at the chats yet, but I can just in my peripheral vision, I can see comments coming through, or did see comments coming through, and like a big X with a big old question mark and an exclamation mark. But yeah, did anyone trade CPI release, or did you kind of wait to see what had happened from the markets from the market reaction? It looks to me that okay, so dollar yen has kind of it's of course gone past pre-release levels. Euro dollar still not there yet. Dollar Swiss franc near enough there. It did touch it. GBP USD no chance. Not there yet either. So Euro USD and dollar yet and cable, excuse me, haven't retraced to their or gone back to their prior trading levels. Gold. So I did see a tick towards the downside there, about 61 ticks. Let's see what was its peak then. So about 90 ticks was the downside. Then on gold there. There. Right, and then we did see the reversal towards the upside. Hope no one was bullying anyone in the chat. We're probably just having fun. Yeah, I don't think there was any bullying. Please don't. Not with macro ace. We're lovely people. Pokes and jibes are cool. But yeah. Anyways. Right. So CPI data was better than expected overall. Okay. Orbiter data came in higher than expected. The Canadian employment data was also better than expected as well. Okay, and you'd seen the Canadian dollar see that strengthening off the back of that data. Of course, with the dollar CAD, that, as I said during the presentation or during the beginning of the stream, the CPI data was going to take precedence, or was potentially going to take precedence, and it did. And hence you'd seen a 38.5 pip move towards the upside on the dollar CAD rather than some weakening instead. But yeah, let me make my way through the comments now. Okay, all right. Going all the way back to the beginning. So we had Active Himelda said, I still don't understand why there are only 12 people watching this. Well, this is the most advanced insight, but if it was just flashlight on technicals, you'll see over 1,000 views. I think a key thing with that, remember, so financial juice, right? One thing with financial juice itself and what we do at Macro Ace is that a lot of traders don't have access to a live voice and text service, so they're not able to understand maybe why the market has reacted in a certain way. So they might look at the technicals and say, oh, this is why the dollar had dropped, or this is why the S&P 500 has seen an appreciation. But of course, you've got to, I think you've got to try and balance it, both technical and fundamental. But if a lot of traders don't have access to the fundamental side of looking at news, and that could put them at a disadvantage, right? Investment banks have both, of course, the technical prowess, and they have the fundamental data coming through to them of headlines and geopolitical events and central bank speakers and headlines of traders pricing in rate hikes from the Federal Reserve, those sort of things that could add further downward pressure on the S&P 500, which at the moment still hasn't got back to, is nowhere near getting back to its pre-release levels. But it's one thing that traders have, if you're aware of what's going on fundamentally and also technically, right, then it's a perfect mix. And that's what investment banks do. And that's why they have a live voice and text service or a Squawk service that allows them to be able to do that. So with financial juice, that is the big key, right? So you have the live version of financial juice that we have, which has delays, has ads popping up in the feed, delay to the economic release figures as well. Although there is a 10-second delay to those site overall, you really want real-time news coming through to be able to kind of capitalize or manage your risk within the markets. So the financial juice So Financial Juice Pro gives you that real-time news via voice and text, and you're able to manage your risk better, just like investment banks do, right? This is high-grade stuff that isn't readily available to the everyday public to be able to go through and look at the fundamental bits of news. They'll see on Twitter, maybe, but it might be, again, it might be there might be a lot of delays that could happen, and you don't really get a lot of news coming through as well. But we have Financial Juice in one place where you get the news, the economic releases, okay, on the side here, and they're color coded as well. Not an indicator as of for advice, but just to kind of show whether a figure was higher than the forecast or lower, depending on what the release is. And you also have your voice feed here as well, all in one place. So Financial Juice Pro is a dime to something that you've got to try out and try and get used to try and managing a trade, or maybe capitalizing on a bit of news, but that's one option that you have available to you, and that's something that we want to provide to you guys with a 7-day free trial here of Financial Juice Pro. I've just put in the chat for the link there that you can have a trial of it. Have a little mess around with it, see what kind of works with you. As I said, the light version, that is still, as I said, there's a 10-second delay to it, but to really do well, to really manage your trade properly, or to kind of capitalize on market movements and to understand what's going on as soon as possible, you want the real-time news to be able to capitalize on that, right? Okay, so that's Financial Juice. Then, of course, we're looking at Tick Strike right here. Okay, so all these little market moves that I've got going on that we're seeing at the moment. Wow, GP CAD is still down. All the market moves that we're seeing at the moment. So what Tick Strike does is it allows you to listen to order flow and look at it visually too, right? Via this here. So you can see these numbers, and you see a color code here. So what Tick Strike does, it represents the amount of momentum that there is within a certain asset or a certain instrument or instruments, if you're looking at a broad measure of momentum. So, for example, if I'm looking at the Canadian dollar and the US dollar, I've got my USD CAD, dollar yen, euro dollar, and I've also got cable there as well. So overall, you can see if we're looking at, if you were to kind of utilize it in one way, it could be to, if the market is moving in one direction the same, that's something you can capitalize on or manage your risk with. Again, so as you can see, Tick Strike is going off. Now, what are these numbers? Okay, so the numbers represent the level of sensitivity. 1 is the most sensitive. So when there is a little bit of movement going on in the markets or in a certain instrument that you're looking at, if I'm bringing up GPCAD here, if there's a little bit of buying going on, then you'll see the notification, or you'll see the alert appear in front of you, whether or not there's buying or selling going on. And that's going to chop and change quite a bit. So if you're a scalp trader, if you like scalping, then, seeing the momentum, is what customers have said to me is how they use Tick Strike. Doesn't mean that you have to use it the same way. Do whatever you want with it, have a little play with it, which will provide a free trial of that too. But so level 1 is the most sensitive, and when you increase the level to level 15, that is the least sensitive, right? So only when there's a big amount of movement or momentum in that instrument or instruments, if depending on how you want to chop and change your sensitivity, only then will the notification or will the alert appear for you that there's either buying or selling going on. And by that point, there'll be a lot of buying or selling that's going on. Again, totally up to you guys how you'd want to use it and manage your trades or capitalize on maybe market moves, or maybe there is a headline. If we're looking at the NQ or the S&P 500 still going down, I've put the ES on 15. the S&P 500 15. So looking for a big move is basically when we would start to see tick strike start to go off there. But this is something that you can chop and change, right, to whatever level suits you of sensitivity to kind of manage your risk or to add to your trading strategy. So, like I said, we want to give you a 7-day free trial of Tick Strike as well. And that is there. 7-day free trial of Tick Strike. Have a little play with it. There is a mini explainer video as well to kind of go through how to kind of use it in its basic way, all the instruments and what those little bits mean. But as I said, go to town on it, just really start to mess around with it, see what happens. So that's Financial Juice and Tick Strike. And of course, if you love this video that I made, or this live stream, and you found the information useful, follow us on Twitter. Give us a follow. Show us your love. And, don't forget to like and share this video, and also subscribe to the channel too. And then finally, for Macro Ace as well, every Sunday I put out a video. I put out an email of what to expect for the week ahead, right? So that's the releases that we'll be covering, some of the bits of news to be aware of, the weekend wrap or the news from the weekend that is important for the markets to know before the Asia market opens up, before the other markets open up, and also the deviations for the releases too. So I know, of course, I went through them quite quickly here myself, but if you are subscribed to the mailing list, then you're able to take your time with understanding how the markets had reacted to a certain release, such as the inflation readings, and whether or not you can kind of pick up your own pattern of what to kind of expect, and use that data however you want, right? It's not advice, it's just a historical reference of what happened when the figures came out at a certain level. This was the market reaction. Okay, so remember, you have the initial candle, okay, so going from the start of the candle to the wick, and in the brackets represents the movement after 10 minutes of the release, okay? So there's quite a bit of detail that is added there, going across different instruments and different asset classes that I go through in detail to provide to you guys, so you can manage your trade, or maybe capitalize on a potential trade, whatever it may be. But that is also put in as